Whole life insurance, often the bane of many financial advisors, and you'll often hear people complaining about it. But lend me your ear as I share a story with you from a long time ago that can illustrate the importance of cash value life insurance, whole life in particular, as we kick off Whole Life Insurance Month here on the Life Insurance Financial Education Podcast. This is from MassMutual's website, a story from 1933 during the Great Depression in Michigan. The state, particularly Detroit, was suffering. In February 1933, a combination of state and federal actions closed banks there for roughly 3 weeks. During these hard times, MassMutual companies had been borrowing against their life insurance policies to make ends meet. But with the banks closed, customers had no place to cash their checks. So MassMutual sent $300,000 in cash to its agencies in Michigan. More than 15,000 policyholders came to that Detroit agency to borrow from their policies' cash values. This was according to Richard Hooker in his History of MassMutual: A Century of Service, published in 1951. Now, the problem was compounded by the weather. It was a tough February in Detroit, with temperatures going as low as negative 13 degrees Fahrenheit. As a result, local coal supplies were running low. A coal dealer came to the MassMutual agency. The railroads had his coal but wouldn't release it unless they were paid. He had plenty of money, but it was in the banks, which were closed. He needed $100,000 in cash. He asked for a loan from his $115,000 single premium life insurance policy that he had purchased from MassMutual 2 years earlier. This, of course, had some implications for the policy itself. It obviously, when you take a loan, reduces the policy's cash value and the death benefit, and could potentially result in a tax liability, but he was in a tough spot. And MassMutual, being a great company that it is, did what they could to help. He was desperate, with telephones ringing in every coal yard office where people were insisting upon delivery of coal, especially there in the schools, hospitals, orphanages, and homes where there was illness. And it was cold in Detroit. Agency there didn't have enough cash on hand to help him, so it called the MassMutual home office in Springfield, Massachusetts. A series of phone calls to 3 Federal Reserve central banks and 1 local branch resulted in the agency getting $100,000 from the local bank's vault. It took about 6 hours. When the policyholder called them at their office, they had satchels and armed guards on each side of him, and they handed him an envelope with $100,000 in it. Within a few hours, the coal in the railroad yards had been released. Trucks started to travel throughout the city, delivering coal to keep the home fires burning and relieve the suffering. What could have been a very difficult health situation turned into a time where children and men and women were able to keep warm. The coal dealer's customers got their coal, and a few days later, the banks reopened. So, life insurance coming to save the day, time and time again, as we will come to find out the more you dig into it and get to hear about the stories out there. Carlo, I think you have a couple to share.
So a lot of times in content, and there's things like posts and videos that I've done, I'll talk about the Rockefellers and the Rockefeller method. This is referenced a lot by Garrett Gunderson, and the contrast of the Rockefeller family and the Vanderbilts, and that family bank that the Rockefellers used. So this goes way back. Similar levels of wealth for both of these families, but implementing the system using whole life insurance as that foundational banking system. It was a really powerful tool. And then another big one that most people are probably familiar with, the brand at least, is Walt Disney had run into various challenges in trying to fund the initial build-out of Disneyland. And so he did various things, one of which was taking, I believe, a $50,000 loan against the cash value in his whole life policy. And that was what he used as that initial seed funding for building Disneyland. So really, a lot of history has been driven by whole life being that place where people can fall back to for funding when they need it.
Yeah, before the stock market even existed, whole life insurance existed. We're going to briefly touch on its history, and then we're going to talk about what it is. And in the weeks to come, we're going to go over everything you need to know about whole life insurance, including paid-up additions. We're going to talk all about the dividends. There are different, what we call flavors: direct recognition, non-direct recognition, participating, non-participating. And when we complete that wraps up December. Starting next year, we're going to go over Becoming Your Own Banker, and the book that kind of started it all for people like us in the cash value life insurance space, and realizing what a powerful financial tool whole life insurance can be. Now, whole life insurance has been around for a long, long, long time, hundreds of years. In fact, the first organized entities here in America came about in the 1700s.
So originally, it was sort of like final expense policies for some religious ministers that were having trouble covering some of those expenses because they were not super wealthy when they passed away.
Yeah, it was basically to protect widows and orphans of these ministries. And then we had a transition to publicly available insurance, basically between 1787 and 1837, where there were like 26 companies offering life insurance to the general public. Most of those short-lived, didn't sell very many policies.
So a critical turning point was in the 1840s, and some regulatory things that came to play, and the move toward mutualization, or this concept of shared ownership in the life insurance business.
Yeah, by 1850, insurance in force approached $100 million across now 48 companies. One of the biggest impacts, though, and what we still see today, had to do with the structure of whole life insurance and when it was fundamentally transformed by regulatory actions that were meant to protect consumers and standardize the contracts. This happened in the early 1900s as a result of the Armstrong investigation, which was a major inquiry into corruption and practices within the New York life insurance industry.
Yeah, so that Armstrong investigation, one of the direct outcomes of that was some legislation that implemented the requirement or the ability to have loan provisions in life insurance.
Yeah, and now the policy loan feature is a legislative right enshrined in the rules here in America for life insurance. You have the contractual ability to be able to borrow against the cash value of your policy. That cash value representing the current value of the future death benefit that you've purchased.
And that's really key because that is the foundation of which we talk about in our own use of life insurance with this infinite banking concept, or I like to call net wealth finance. Because without that loan provision, then we would not be able to do all of the amazing things that we can do with our life insurance policies.
Some of those loan provision impacts reflected in the stories we talked about at the beginning of this episode. Where would Walt Disney and Disney World and Disneyland, where would they be today if not for that legislation requiring the policy loan provisions? It's possible that the insurance companies that they had policies with would have made that cash value available, but maybe they wouldn't have been able to. We just don't know. Fortunately, we don't have to guess. It was available, it came in handy, and it's made a significant impact on many people's lives throughout history. Let's dive into what whole life actually is. What are people buying?
So at the foundation of whole life is the guaranteed death benefit that you are paying for, that is guaranteed for whole life as long as you pay the premiums that you've agreed to at the start of that contract.
Yeah, the contract for whole life says you make payments over X number of years, and they're going to guarantee you that there will be this death benefit when you die, whenever that is, between age, whenever you're starting it, and age 100 or 121. Those times have changed when the policy matures. Those times have changed throughout history here. We're now at age 121. And as medicine advances, we may see that extended again when people start living longer than 121. But essentially, you have that guaranteed death benefit. Along with that death benefit, you know exactly what the cost is going to be to keep that policy in force. It doesn't matter if you're paying over 10 years or 20 years, or whatever the agreed upon contract says.
Yes, that's That's the guaranteed premium. For that whole life policy, you do have a guarantee premium. When you sign that contract, that is the amount that you're required to pay. Now, we do other riders and other things that are also attached, but that guarantee of that base whole life policy, that is guaranteed as long as you have that policy contract in force.
Beyond the guarantee for that death benefit, you also have guaranteed growth. Each policy has a certain amount of guaranteed growth that will happen throughout the life of the policy so that the cash value will reach that death benefit at maturity. And that's something that you just don't get with almost any other financial product. There's no contractual guarantee that your cash value will go up at a certain rate every single year.
And so those guaranteed rates, they're not fantastic. These at the time of this recording, they're 2% to as much as 3.75. But one of the reasons why we love whole life is they have a strong history of paying what's called a surplus dividend beyond those guaranteed rates. This is an amount that, I'm very happy with in my own policy, and it can be strong returns. And that's where we talk about that internal rate of return being in that 4 to 6% over the life of your policy. And when you can lock in that amount of return, it might not sound like a whole lot, but over your entire life, knowing that that is as close to guaranteed as anything in his life, it is a really powerful thing.
Now, before we get too deep in the numbers on any particular policy and growth and internal rate of returns, all whole life insurance policies do offer a triple tax advantage. You've got tax-deferred growth in the cash value accumulation, you have a tax-free death benefit, and you have tax-advantaged access to that cash value via withdrawals or policy loans throughout the life of the policy.
For those tax-free withdrawals, that's where we'll talk about withdrawing up to your cost basis. So your total amount of premiums paid in, if for whatever reason you need to access those funds and you want to do those as withdrawals, you have the option to withdraw up to your cost basis, the total amount of premiums you've paid into that policy.
So to wrap up this initial introductory episode on whole life and what it is, the foundational strength of whole life insurance rests upon those contractual guarantees: fixed premiums, guaranteed growth, lifetime coverage, access to that cash value, and at its base, you now have an asset that is uncorrelated with traditional stock and bond markets. This is a powerful tool that many, many people have used throughout history, and we continue to advocate for moving forward. And the way that we can design these things these days is truly amazing. But we will be back in the coming weeks again to talk more in detail about the specific things inside of whole life and what you should look for when you're in the market for a whole life policy so that you can get something that's properly designed and that will help to fit your overall financial goals and needs. Carlo, do you have a call to action for our listeners this week?
It's time for this week's call to action.
If you haven't personally seen an illustration for your situation, or even if you have and you're not sure about it, get in touch with one of us, book a meeting. That is one of the most powerful things, is to see an illustration that is optimized for your specific situation. It is a really great thing and a fantastic tool. Would love to talk to you about that and help you to build this solid financial foundation that whole life can provide.
I do love sharing illustrations. I think that they're great for understanding how these things work. Where I would suggest people spend some of their research time is check out the financial strength of these large mutual whole life companies. And we're going to dig into this a little bit later in the month as far as why being a mutual company is beneficial. But essentially, when you buy a whole life policy with a mutual company, you become part owner of that company. Check out the financial strength of these companies and their history and ask yourself, is that someone I would like to partner up with? Do I want to own a piece of that company and the profitability of those companies? It's an interesting exercise. That's my call to action. Check those out. See if that might get you kind of excited about adding that type of an asset to your overall portfolio. Join us again next week for Paid Up Editions. The key to a properly designed, high cash value life insurance policy that has an incredible amount of liquidity, including in year one. Appreciate you joining us. I'm James Barber, your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And my name is Carlo Vaquera. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. See you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.